Dr. Paul. Yes.
Thank you, Mr. Chairman. Appreciate this opportunity. First, I would like to say I hope the Humphrey Hawkins requirement continues. I think that's important. I do also note that frequently at these hearings we don't talk much about monetary policy, which is the purpose of the meeting. We frequently talk about taxes and welfare spending. But I would like to concentrate more on the monetary policy and the value of the dollar. There are some economists who in the past, such as Mises and Hayek, as well as Friedman, have emphasized that inflation is a monetary phenomenon and not a CPI phenomenon. It's not a labor cost phenomenon. And that when we incessantly talk about this, whether it's the Federal Reserve, Treasury, or the Congress, or the financial markets, we really distract from the source of the problem and the nature of our business cycle. I certainly agree that technology has given us a free ride and has allowed us this leverage, but we've also been permitted a lot of inflation, that is the increase in the supply of money and credit. Since 1987, we have had a tremendous increase in money. The monetary base has doubled. M3 has gone up to $2.5 trillion. And this money has gone into the economy, but we have reassured ourselves that the CPI has been stable, so therefore everything is okay. Yet the CPI has gone up 44% since 1987. Real growth on the GDP has not been tremendous. It's about 2.3 per year. But we've had a tremendous increase in capitalization in our stock market, going from $3.5 trillion up to $14 trillion. So that's where the money's going. This generates revenues to the government. This has helped us with our budgetary problems. At the same time, we ignore the fact that hard money people emphasize that not everybody benefits. And there has been a lot of concern expressed that people are left behind. Farmers are left behind, the marginal workers left behind. Some people suffer from a higher CPI than others. But these are all monetary phenomenons that we tend to ignore. But you have admitted here today and in the past that the business cycle is alive and well and that we shouldn't ignore it. In your opening statement that we should be especially alert to inflation risks, and I think we certainly should be. And you have expressed concern today and at other times about the current account deficit. And this is getting worse, not better. Our trade balances are off. But I would suggest maybe we have seen some early signs of serious problems because foreign central bank holdings now of our dollars have dwindled to a slight degree. In 1997, they were holding over $650 billion, and they're slightly below $600 billion. And at the same time, we have seen income from our investments dwindle to a negative since 1997. So I think the problems are certainly there. But I would like to talk a little bit more about, or ask you a question about this balance of trade and the value of the dollar. Because history shows that these dollars eventually will come back, and you have assumed that they will. But that's essentially the problem we got into in 79 and 80, and there's no guarantee that that won't happen again. That means that the markets will drive interest rates up. We will have domestic inflation. The value of the dollar will go down. Now, my question is, what will your monetary policy be under those circumstances? In 1979 and 1980, you were, not you, but the Fed was forced to take interest rates as high as 21% to save the dollar. But my suggestion is it's not so much that we should anticipate a problem, that the problem was already created by all the inflation of the past 12 years, and that we have generated this financial bubble worldwide, and that we have to anticipate in that. And when this comes back, we're going to have a big problem, and you have to deal with it. And my big question is why would you want to stay around for this? It seems like I'd get out with it while the getting's good.
Dr. Paul, you're raising an issue which a significant number of people have been raising over the years, and for which, frankly, we're not quite sure what the answers are. It's by no means clear, for example, that one can trace the increase in money supply, which presumably has not reflected itself in CPI, into stock values. I mean, a lot of people say it's happening, and a lot of people assume that's what it is.
May
but the
I-
evidence is not clear by any means.
May I interrupt, please? Did you not write that that was the case with the 1920s and this was a problem that led to our depression?
No, I didn't raise the issue that, in effect, that the money supply per se, what I was arguing many, many years ago, and I still think is doubtless the case, is that in 1927, involving ourselves with an endeavor to balance the flow of gold in favor of Britain at that time, that we did create a degree of monetary ease, which was one of the possible creations of speculation in the market in 28 and 29. What is not evident in today's environment is anything like that is going on. We cannot trace money supply into a speculative bubble. I think that if a bubble in fact turns out to be the case after the fact, we will have a considerable amount of evaluation of where it came from. But as I've said before this committee and indeed before the Congress on numerous occasions, I think that we are uncertain as to the extent to which there is a bubble because, as I said in my prepared remarks, to presume there is a bubble at this particular stage of significant proportions, and a bubble that isn't significant doesn't have any meaning, we have to be saying that we know far more than the millions of very sophisticated investors in the markets. And I've always been very reluctant to conclude that. We do know that a significant part of the rise in prices reflects rising expected earnings, and a goodly part of that is a very major change in the view of where productivity is going. What we do not know is whether it's being overdone or to what extent it's being overdone. I've always said I suspect it is, but firm, hard evidence in this area is very difficult to come by. It's easy to get concerned about it on the basis of all sorts of historical analogies. But when you get to the hard evidence, we do know that inflation is a monetary phenomenon. What we have very great difficulty in knowing is how to measure what that money is. Remember, M2, M1, all of that are proxies for the money that people are talking about when they're referring to money being the creator of inflation. We have had great difficulty in filtering out of our database a set of relationships which we can call true money. It's not MZM, it's not M2, it's not M1, it's not M3, because none of those work in a way which would essentially describe what basically Hayek and Friedman and others have been arguing, and I think quite correctly, on this issue.
Thank you very much, Dr. Paul.